If you own AMD right now, one of two things is true. Either you're sitting on a triple wondering whether to ring the bell, or you bought in July north of $550 because everyone promised you the same thing, that earnings would justify the price. Monday night, earnings arrived. AMD beat every line and raised its guidance. Tuesday, the stock fell 7%. That's not a bad quarter getting punished. That's a perfect quarter getting punished. And the reason is one number nobody in that press release wanted to print. At Monday's close, buyers were paying roughly 170 times the last 12 months of earnings. So tonight, 5 investing methods score this stock. One gives it an 8, one gives it a 1. I'll be back with the board's number and the one trigger that flips it. But you need the numbers first.
With the line that decides everything, AMD's data center division did $6.7 billion in 3 months. A year ago, roughly half that, 107% growth, about $200 million above consensus. Jean Hu, the chief financial officer, said it plainly. Data center is now 58% of this company. The rest, quickly, client chips $3 billion up 23, embedded just under $1 billion up 19, gross margin 54% up 14 points in a year, then the red bar, gaming $779 million down 31%. That's the graphics card in somebody's bedroom shrinking by a third while the data center doubles. 42% of this company isn't pulling, hold that, the fourth chair picks it up. Then AMD guided next quarter to $13 billion, up 41% ahead of the $12.5 billion consensus. Who told the street to expect acceleration in the second half? So record revenue, every line beat and guidance raised, and the market sold at 7%, which tells you the quarter was never the argument, the price is. So what is AMD in plain words? It designs chips and it doesn't build them. Everyone is made in Taiwan by TSMC. AMD's edge is a manufacturing trick. Instead of printing one enormous piece of silicon and hoping it's perfect, it prints small ones called chiplets and stitches them together. Better yields. It's how a company that was nearly dead beat Intel. Nearly dead isn't a figure of speech. In October 2014, Lisa Su took over AMD when the whole company was worth about $3 billion and the industry had written it off. An engineer, 3 degrees from MIT, and she bet everything on chiplets. Today, AMD is worth $789 billion, roughly 260 times computed from those two figures. One footnote because nobody says it enough. Lisa Su is a cousin of Jensen Huang, who runs Nvidia. This war is a family argument. Here's the ladder the whole episode hangs on. At the peak $584, AMD traded near 191 times trailing earnings. At Monday's close, about 170. Then Tuesday's profits landed in the trailing figure and the price dropped, so today it's 123. Nvidia trades at 34, Broadcom 71. Now the other side of that ladder. On next year's expected earnings, AMD is 43.5 times, Nvidia is 22.4, and AMD's PEG, the multiple divided by the growth rate, is 0.73, under 1. On that measure, the most expensive large chip stock alive screens cheap. So the question is exactly this. Does a company growing 50% deserve to cost 3.5 times Nvidia's trailing multiple? The board convened on the 7th of August, 2026. These are the numbers it saw. Chair Peter Lynch built his record on an idea that fits on a napkin. A fairly priced company trades at a multiple equal to its growth rate. His words verified.
The PE ratio of any company that's fairly priced will equal its growth rate.
Run it, non-GAAP earnings grew 246% year over year. Revenue grew 50. The multiple is 43.5 forward. That's a PEG of 0.73, and by Lynch's arithmetic, anything under 1 means the growth is outrunning the price. The balance sheet backs it. $8.8 billion in net cash, $8.4 billion of free cash flow. This company funds its own war. The Lynch model scores AMD an 8, driving number that PEG. What flips it? Forward growth under 30% while the multiple holds. 1 chair in, an 8. Now the method that wouldn't touch this stock anywhere near today's price. Benjamin Graham taught Warren Buffett, and he reduced investing to 3 words he actually printed: margin of safety. He also wrote the sentence that ends this chair before it starts: verified.
The margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price.
Graham's screen wanted a multiple near 15. AMD is at 123. He wanted a price close to what you'd recover if the company stopped growing tomorrow. AMD's enterprise value is 19 times annual sales. Every filter fails and it isn't close. The Graham model scores AMD a 1, driving number that trailing multiple. What flips it on Graham's own arithmetic? 15 times reported earnings, about $58 a share. The stock is 483. This method isn't calling the business bad, it's saying the price carries no protection. 2 chairs in, an 8 and a 1. The average is 4.5 and neither of them is anywhere near it. That gap is the episode. Third chair, Philip Fisher never screened for cheapness. He hunted companies he'd never have to sell and judged them on management and research. Verified.
There is my approach, which is to find something so good, if you don't pay too much for it, that it will have very, very large growth.
On the business, this passes hard. Gross margin up 13 to 14 points in 12 months is a company gaining pricing power, not renting it. And Lisa Su is exactly the operator Fisher hunted for. But Fisher wrote this too, verified. If there's standing room only, that's usually a pretty fair sign it's not a good time to buy the stock. The Fisher model scores AMD a 7, not a 9, and the haircut is entirely the crowd, driving number that margin climb. What flips it? 2 straight quarters where data center growth decelerates and the margin stops rising. That's the tell the pricing power was rented. 3 chairs in, 2 bulls, 1 bear, average 5.3. And before the 4th chair speaks, there's a document the board had to price and it isn't in the earnings release. October 2025, AMD signed a supply deal with OpenAI. 6 gigawatts of AMD accelerators, which is a quantity of electricity, not a quantity of chips. That tells you the scale. Attached to it is a warrant. OpenAI can earn up to 160 million AMD shares at 1 cent each. AMD has about 1.63 billion shares, so that warrant is roughly 10% of the company computed at a penny a share. And the final tranche carries a condition. It vests when AMD's stock reaches $600. Read that again. The biggest buyer of AI chips on the planet is contractually rewarded for AMD's stock going up, and if it goes up enough, it collects 1/10 of the company for nothing. Best customer contract in the industry, or 10% dilution inside the bull case. Howard Marks runs the largest distressed debt firm on earth, and he has one idea above all others. First-level thinking says it's a good company, buy it. Second-level thinking asks what everybody already believes, verified.
The most dangerous thing is to buy something at the peak of its popularity. At that point, all favorable facts and opinions are already factored into its price.
So this method reads Tuesday as evidence. Perfect news, negative reaction means the good news was already paid for, and it has a precedent from the same narrative, the same 12 months. Oracle rode the AI infrastructure story to about $345 last September. It trades at $147 today at 25 times earnings. Nobody rang a bell at the top. The Marks model scores AMD a 3, driving number that -7% on a beat. What flips it? The forward multiple compressing into the low 30s while data center growth holds. Same company, better entry, 4 chairs in, 8-1, 7-3, 2 bulls, 2 bears, dead even, and the last chair decides it. Stanley Druckenmiller compounded 30% a year for 3 decades by refusing to look at what a company earns today. Verified.
Never ever invest in the present. It doesn't matter what a company's earning. You have to visualize the situation 18 months from now, and that's where the price will be, not where it is today.
18 months out, this method sees a $13 billion quarter guided, a second source the hyperscalers genuinely need, and a warrant paying the world's largest AI customer to push this stock toward 600. That's the asymmetry he hunts. He also uses valuation for one purpose only, and he says so: to measure the risk in a position, never to time it. 123 times trailing puts that dial at maximum, and the tape just argued with the story. The Druckenmiller model scores AMD a 6, driving number that 13 billion guide. What flips it? If AMD can't reclaim the pre-earnings close of $518.58, the price is contradicting the reasons for owning it, and this method sells. 5 chairs, 81736. If you'd rather watch 5 real methods argue than be told what to buy, that's this channel every week. Subscribe and tell me in the comments which chair you think got it wrong.
5.0 out of 10, and that number is nearly useless because the spread is 7 points, widest this board has ever been. Here's what it means. Not one of these 5 methods thinks AMD is a bad business. Every one of them accepts the growth. They aren't arguing about the company, they're arguing about the price. And here's my number, and it isn't a price target because I don't give those. Mine is 43.5. The forward multiple. Work backwards and the bet is exact. At $483 you're paying today for about $11 of earnings per share that AMD hasn't made yet. Last year it made $390. Not whether Lisa Su can build it, whether she can build it that fast. So watch the triggers, not the headlines. Growth under 30% and Lynch's 8 collapses. 2 quarters of data center deceleration and Fisher's 7 goes. The forward multiple into the low 30s and Marks turns buyer. Failure to reclaim 51858 and Druckenmiller's out. And $600 where OpenAI collects a tenth of the company for a penny a share. 5 triggers. Nothing here is financial advice and none of us knows which one fires first. The board saw the 7th of August 2026, $483, 123 times trailing, 43.5 forward, peg 0.73. The methods are timeless. The numbers aren't. So rerun it yourself with 3 inputs. Today's price, today's forward earnings estimate, today's data center growth rate, post your score. Next earnings land in early November on AMD's usual cadence.
Next on the board, the company whose entire valuation rests on a customer that's building the thing designed to replace it.